Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at UiPath.
If you find our talks useful, please consider subscribe, like, and comment underneath. So look, imagine crossing basically the ultimate finish line.
Right.
You know, you build a company, you grind for years, and you finally become incredibly profitable.
Yeah.
You're sitting on billions of dollars in cash.
Living the dream.
Exactly. You literally do everything right. And Wall Street responds by slashing your stock price by nearly 40%.
Yeah, it's brutal.
It is.
Yeah.
And that is exactly what is happening to UiPath right now. If you are looking at your portfolio today, trying to navigate these wealth building opportunities, this is, it's one of the most glaring contradictions in the entire market.
It really is. The disconnect between the operational reality of the business and the actual stock chart, it's staggering.
So we need to figure out, is Wall Street completely wrong here, or do they see some kind of trapdoor that we don't?
Right. And to understand the magnitude of this disconnect, we really have to look at the actual numbers they just posted for the fourth quarter of fiscal 2026.
Let's get into it.
So the financial performance is incredibly robust. Revenue hit $481 million.
Okay.
Which, that's a 14% increase year over year. And it beat analyst estimates by about 3.5%.
Which, in a tight macroeconomic environment where enterprise IT budgets are just under a microscope, beating top-line revenue estimates by 3.5% is not a small feat.
No, not at all. It shows serious resilience. But the real lifeblood metric for any enterprise software platform is annual recurring revenue.
Right, ARR.
Yeah, if you're investing in software, ARR is basically the compounding interest of the business. And UiPath's ARR reached $1.853 billion.
Wow, over $1.8 billion.
Yep. They added $70 million in net new ARR just in that fourth quarter alone.
That's a huge jump.
It is. However, the absolute defining milestone of this earnings report wasn't just the top-line revenue, it was the profitability pivot.
Okay, the pivot?
Right, because for the full fiscal year 2026, they reported a GAAP operating income of $57 million.
Right, let's pause and translate that real quick.
Sure.
Because I want to make sure the underlying mechanics are crystal clear for everyone listening. We hear GAAP and non-GAAP thrown around constantly in these earnings calls.
Oh, all the time?
Right. So why is achieving, true GAAP profitability such a rare milestone that it completely changes the profile of a software company?
Well, the software sector is notorious for companies that show, massive revenue growth, but they bleed cash for a decade.
Right. Growth at all costs.
Exactly. And to mask that cash burn, companies use non-GAAP metrics, which conveniently strip out massive expenses, usually things like stock-based compensation.
Ah, so they essentially pay their employees in stock to save their actual cash.
Exactly. But it heavily dilutes the everyday shareholders, you and me. So hitting true GAAP profitability means the underlying business engine is now entirely self-sustaining.
Without relying on the accounting tricks.
Right. The revenue actually coming in the door is genuinely higher than the total cost of running the company.
So they are basically graduating from a high-burn growth story where they constantly need to raise capital to a real cash-generating machine.
Yes. And that operational discipline is evident across the board. Their non-GAAP operating margins expanded significantly to roughly 31% in the fourth quarter.
31%. That's solid.
It's fantastic. Management is seeing so much internal efficiency that they actually raised their long-term margin target to 30%. They're basically telling the market, we know how to run a lean, highly profitable business.
Which I assume leads directly into the balance sheet.
Oh, absolutely.
Because when I look at the financial data you brought here, fortress is literally the only word that comes to mind.
It's a great word for it.
They're sitting on $1.69 billion in cash, cash equivalents, and marketable securities. And the kicker, zero reported long-term debt.
Yeah, zero. In this unpredictable macro environment where, the cost of borrowing capital is incredibly high, having nearly $1.7 billion in liquidity and no debt hanging over your head is the ultimate defensive moat.
It's basically bulletproof.
Exactly. They are insulated from credit crunches. And on top of that, they generated $372 million in adjusted free cash flow for the full year.
And they aren't just hoarding that cash either, right?
No, they're deploying it.
Because this is where it gets highly actionable if you're currently holding this stock.
Oh.
They just completed a massive $1 billion stock repurchase program. Done. Executed.
Right.
And they immediately turned around and authorized a brand new $500 million buyback program. I mean, that is aggressive corporate action.
It's highly aggressive.
They are systematically using their own fortress balance sheet to buy up their own shares, which effectively reduces the overall supply and boosts the value of the shares that remain.
Exactly. Capital allocation of that magnitude sends a very specific message.
That the stock is cheap.
Right. Management believes the stock is severely disconnected from its intrinsic value. But to understand why they believe in that intrinsic value so strongly, we have to look past the balance sheet.
Okay, look at the technology.
Yeah, examine the technological moat they're actually building. The industry buzzword right now is governed agentic automation.
Governed agentic automation. I mean, that sounds like something out of a sci-fi novel.
It kind of does, yeah.
What does that actually look like when deployed in a real-world Fortune 500 business?
Well, the current artificial intelligence market is obsessed with generic AI models, right?
Right.
The massive language models that offer just, raw intelligence. The problem is they lack enterprise guardrails.
What do you mean by guardrail?
Well, if you ask a generic AI to help optimize your company's payroll, it might just start drafting termination emails to save money.
Oh, wow. Yeah, that's a problem.
Exactly. It lacks context and rules. So UiPath provides a proprietary orchestration layer called UiPath Maestro. It governs what they call agent swarms.
Okay, let's ground this in a practical analogy, because understanding this mechanism is absolutely vital for your wealth-building thesis here.
I agree. Go for it.
Think of raw AI, those generic language models from OpenAI or Anthropic, like a brilliantly fast, ridiculously powerful race car engine.
Okay, I like that.
It has immense potential speed. But if you drop that raw engine onto a corporate track without a steering wheel or brakes, you get a catastrophic crash.
100%.
UiPath is the software providing the chassis, the steering wheel, and the track rules, the essential enterprise guardrails that make the speed usable for mission-critical tasks.
That's spot on. And the technical term for those track rules is compliance-first integrations.
Right. So going back to your payroll example, UiPath Maestro is the underlying code that says to the AI, you can analyze the data and suggest cost-saving optimizations, but you absolutely cannot execute a termination without human HR sign-off.
Exactly. It is the literal hard-coded guardrail.
Yeah.
And building those guardrails is incredibly complex, which is why UiPath is integrated deeply with major infrastructure players. Like who?
We're talking NVIDIA, Snowflake, Google. They have also achieved something called AIUC1 certification for agent security.
Let me jump in there. What is AIUC1? That sounds like a heavy piece of compliance jargon. Why should an investor actually care about that certification?
It stands for AI Use Case 1, and it is a rigorous enterprise-grade security standard.
Yeah.
When a major bank or, say, a healthcare provider is looking to deploy autonomous AI agents, their IT compliance departments demand proof that the data won't leak.
Right, that the agents won't go rogue.
Exactly. Achieving that certification establishes a level of institutional trust that is just incredibly difficult for a scrappy new AI startup to replicate.
So it's a huge barrier to entry.
A massive barrier. And this trust is what enabled their most significant recent development, the Agentic ERP partnership with Deloitte.
Deloitte, wow. I mean, they are the ultimate gatekeeper for enterprise software.
They absolutely are. They manage the massive multi-year overhauls of enterprise resource planning systems for the biggest companies in the world.
So by partnering with Deloitte, UiPath is entrenching its technology directly into high-friction, mission-critical workflows.
Oh, I see.
Yeah, once an entire corporation's daily operations are layered on top of UiPath's orchestration software, the switching costs become astronomically high.
Because a company doesn't just rip out its core automation layer on a whim. It would break everything.
Exactly. The stickiness of this product is incredible.
Okay, but we need to address the massive logical friction here.
Yeah.
Because we just established that UiPath hit GAAP profitability.
Right.
They have $1.69 billion in cash, zero debt. They are buying back stock, hand over fist, and they have an ironclad certified technological moat embedded by Deloitte.
Yeah, the fundamentals are stellar.
So if the balance sheet and the business model are a fortress,
Yeah.
why are we looking at a stock chart that looks like a crime scene? How do we square this circle?
Well, the answer lies entirely in market technicals and sentiment. The stock is trapped in what technicians describe as a severe drawdown.
That's severe drawdown.
Yeah. It is currently trading right around $10.39. It is hugging its 52-week low of $9.46.
which is miles below its 52-week high, right? That was what, almost 20 bucks?
Exactly, $19.84. Furthermore, it's trading significantly below the analyst consensus target, which sits at
The
$13.80.
momentum is just brutal. We are talking about a 38.6% drop over the last 3 months alone.
It's painful. The market has seemingly dismissed the profitability story entirely. When you look at the analyst community, it is just a sea of hesitation.
Yeah, 17 out of 21 analysts have slapped a hold rating on the stock. Nobody wants to make a bold move.
Which creates a fascinating market dynamic for you as an investor. You have a crowded wait-and-see trade.
But when we look at the data, there is a 15.59% short interest.
That's right.
Let's break that down for a second, because having nearly 16% of the float sold short is a massive deal.
It really is.
For the everyday investor listening, the float is the number of shares actually available to trade on the open market, excluding the shares locked up by insiders. So if 16% of those available shares are sold short, that means a huge number of traders have borrowed this stock and sold it, betting the price will go down even further.
Exactly. And because of that, they are heavily exposed. If the upcoming catalysts shift the narrative even slightly to the positive, you have the perfect recipe for a violent short squeeze.
Right, because all those short sellers would panic, scramble to buy back shares to cover their losing positions.
And that massive wave of forced buying drives the price upward exponentially.
It is an absolute tinderbox.
It is.
But, before we talk about upside, there is a glaring red flag in the sentiment metrics that we really have to confront head on here.
The insider selling.
The insider selling. CEO Daniel Dines and other executives have been dumping substantial blocks of shares.
Yeah, that's true.
We are looking at Dines selling 122,734 shares in October 2025, with subsequent smaller batches through January. Let's be real. If the founder and CEO is dumping over 100,000 shares, why should the everyday retail investor feel safe holding the bag?
Look, the optics of insider selling are always terrible for sentiment. The market hates mixed signals.
Right.
On one hand, you have the company executing a $500 million buyback. On the other hand, the executives are selling personally.
Is it possible that this corporate buyback isn't genuinely a sign of massive undervaluation? Could it just be like corporate financial engineering?
What do you mean?
Like, are they just using the company's $1.69 billion cash pile to bandage over the dilution caused by executives cashing out? I mean, that's what a lot of retail investors are wondering.
It's a fair question, but here is the real insight into how these market mechanics actually operate. We have to look at timeline arbitrage.
Timeline arbitrage. Walk me through that.
Executive stock sales are almost always scheduled through what are called 10b5-1 plans. These are blind trusts set up months, sometimes years in advance, usually for personal tax liabilities or just basic portfolio diversification. It is an autopilot sell-off.
So it's not a panic sell based on today's news.
Exactly. The corporate buyback, however, is a dynamic, highly deliberate decision made by the board of directors reacting to current, real-time market prices. The market is panicking over a pre-scheduled, automated insider sale while entirely ignoring the aggressive, real-time buy-in from the company itself.
That makes a lot of sense.
Furthermore, mathematically, a $1.5 billion combined buyback far outweighs the dollar value of the insider sales we've seen. It is heavily accretive to the everyday shareholder.
So the market is basically in a massive staring contest right now.
Pretty much.
You've got automated insider selling and poor momentum on one side, and aggressive corporate buybacks and pristine fundamentals on the other. Who blinks first?
That's the million-dollar question.
Right. So what is the actual event that's going to force this stock out of this $10 purgatory? Map out the catalyst calendar for us over the next few months.
Well, if you are managing your wealth around this position, the next 90 days are the proving ground. The major event is the upcoming earnings report projected for late May 2026.
Okay, May 2026.
Every single analyst on Wall Street will be hyper-focused on one specific metric: Q1 fiscal 2027 revenue guidance.
Because management has guided for $395 to $400 million, right?
Right.
And the market always trades on the future, never the past.
Exactly the point. If they miss that forward guidance, the algorithmic trading models will mercilessly punish the stock.
But if they beat it?
If they beat it and show that revenue is actually reaccelerating, it could ignite the exact short squeeze scenario we just discussed.
Okay, so that's the financials. What about the actual product?
Beyond the pure financials, investors must monitor the actual product rollouts. The Deloitte Agentic ERP solution is moving from a press release into real-world deployment.
Meaning they're actually installing it in Fortune 500 companies now.
Yes. Additionally, UiPath is doing a wide release of their Agent Builder tool. The market needs proof that these new AI tools are actually converting into billable revenue.
We also really have to factor in the macro environment here, which is shifting dramatically.
Oh, massively.
There is a very real potential for a flight to quality in the broader software sector. For the past 2 years, venture capital and retail investors just threw money at any speculative startup that put the letters AI in their pitch deck.
Absolutely. It was a frenzy.
Right. But now the AI hangover is here, and the bill is coming due. Companies are demanding actual return on investment. If the broader market starts punishing cash-burning, speculative AI plays, the capital has to rotate somewhere safe.
And UiPath, with its JAP profitability and governed compliant solutions, is perfectly positioned to catch that rotating capital.
That makes a lot of sense.
That flight to quality is a potent macro tailwind. The rotation from hype to fundamentals is already beginning. Now, speaking of macro events, there is speculative chatter in the analyst community regarding mergers and acquisitions. The buyout rumors.
Right. The dominant rumor is that UiPath is a prime acquisition target for cloud computing giants, specifically names like Google or Oracle.
And what's the logic there?
The theory is that these massive cloud providers have the raw AI brains, but they are desperate for a ready-made execution layer to sell to their enterprise clients. With UiPath sitting at a depressed valuation, analysts are pointing to a potential buyout.
Okay, I have to stop you right there and just challenge this narrative.
Sure.
Because relying on M&A rumors is an incredibly dangerous game for any wealth-building strategy.
I completely agree.
Let's think about the actual architecture of the software. We just spent 10 minutes establishing that UiPath is heavily integrated into high-friction enterprise workflows, managing deeply complex ERP systems alongside Deloitte.
Right.
It is literally woven into the plumbing of Fortune 500 companies. Doesn't that massive complexity actually make them too difficult and expensive to be easily swallowed by a Google or Oracle?
That's a very valid point. I mean, this isn't some simple consumer app you can acquire and rebrand over a long weekend. Integrating this level of infrastructure takes years.
The integration risk for an acquiring company would be immense, and you are entirely correct to push back on that. Evaluating the company solely on its standalone fundamentals is really the only prudent way to manage risk.
Because betting on a white knight buyout is speculation, not investing.
Exactly. Which brings us to the most important part of any analysis, the bear case.
Right. If we're ignoring buyout hopes and looking purely at standalone performance, what is the fundamental risk that could break this thesis?
The core bear case is the deceleration of their annual recurring revenue growth. The growth rate has slowed down to 11%.
11%.
Yeah, that is a far cry from the hypergrowth days of their IPO era. Forward fiscal 2027 ARR is targeted at roughly $2.051 to $2.056 billion. It is still growing, but it is growing slowly.
But wait, why does a drop to 11% cause such a violent reaction in the stock price? 11% growth in any normal industry is fantastic.
Because Wall Street's algorithmic valuation models for software-as-a-service companies are entirely built on the assumption of 20% to 30% compounding hypergrowth.
Oh, I see.
When your growth decelerates to 11%, the algorithms completely re-rate your company. You get downgraded from a premium hypergrowth tech stock to a mature value stock.
Ouch.
Yeah, that downgrade triggers a brutal multiple compression, meaning investors are only willing to pay a fraction of the price for every dollar of earnings.
So even if they're profitable, the multiple just shrinks.
Exactly. If that ARR growth stalls entirely and dips into the single digits, the valuation will compress even further, regardless of how many billions they hold in cash.
So it all comes down to a scale of weights.
Basically.
On the negative side, we have the mechanical re-rating from decelerating ARR, the poor technical momentum, and the optics of pre-scheduled insider selling. On the positive side, we have a fortress balance sheet with $1.69 billion in cash, a newfound and highly disciplined GAAP profitability, a massive $500 million real-time buyback, and these agentic ERP catalysts deeply embedded with Deloitte.
You summarized it perfectly.
So weighing all of this friction, what is the final verdict for a wealth-building portfolio?
Synthesizing the fundamental strength against the technical weakness, the final investment thesis arrives at a bullish score of 7 out of 10.
7 out of 10. And what's the timeline?
The target horizon for this position is strictly defined as a 12-month hold. This is not a quick momentum swing trade.
What is the core elevator pitch for why this is a 7 out of 10?
UiPath has successfully survived a grueling corporate pivot. They transitioned from a high-burn, growth-at-all-costs startup narrative into a GAAP-profitable, cash-generating leader in governed enterprise AI.
Right.
The current depressed stock price represents a fundamental mechanical disconnect from their operational reality, presenting a rare valuation discount.
So to distill this down for you, the listener, this is fundamentally a patience play. Your downside is incredibly well protected.
Very protected.
You have $1.69 billion in cash acting as a concrete floor, and you have the company stepping in with a $500 million corporate buyback, providing a constant daily bid under the stock price to absorb selling pressure.
Right.
The downside is heavily insulated, but the upside entirely depends on whether this new agentic ERP partnership actually converts into net new ARR over the next 12 months. You are waiting for their financial execution to catch up to their technological superiority.
The market requires irrefutable proof of reacceleration. Until those new compliance-first AI tools translate into hard billing and push that ARR growth back up, the stock will require strict discipline and patience from investors.
And that brings us to a broader, almost philosophical question regarding the future of software that I want to leave you with today.
It's a great point.
It is a critical concept to ponder as you look at your own portfolio allocations. The artificial intelligence revolution is maturing right in front of us. It is shifting rapidly away from consumer chatbots that just talk to you and moving toward autonomous agents that actually do the complex, high-stakes enterprise work.
Exactly.
As that shift happens, will the companies building the boring, unsexy safety guardrails and compliance layers ultimately become far more valuable and deeply entrenched than the companies building the shiny, raw AI brains? Think about the old wealth-building adage. During a gold rush, the people who get rich aren't usually the prospectors blindly digging in the dirt.
No, they're not.
The real generational wealth is built by the companies selling the picks, the shovels, and the safety helmets. Thank you for joining us today. We encourage you to weigh these facts carefully, dig into the mechanics we discussed, map them against your own long-term wealth-building journey, and keep making smart, disciplined decisions. We will see you next time.